Welcome, listeners. You're listening to Deeds in the Desert, the place where real estate investors tune in for the latest news and available investments at Ignite Funding. If you're on the hunt for a low-effort, passive income stream, then turn up that volume and pull out the hammock as we get ready to feed you your weekly dose of real estate investing insights.
Welcome back, listeners, to another episode of Deeds in the Desert. Today's episode, I actually have two guests with me today. First off, I have Howard Robbins, Business Development Executive here at Ignite Funding, and I have Kate Buda, Business Development Executive. Thought I'd double it up today, and we're going to jump right into the episode. So I hope both of you guys are ready. Today, we are going to go over frequently asked questions from potential investors as well as our current investors. So let's go ahead and jump right into it. So, Howard, first one's for you.
Hit me with it.
If it sounds too good to be true, why isn't it?
Well, because you always have to ask yourself, what is it and how does it work? A lot of people automatically will brush off something that sounds too good to be true because of the old adage, if it sounds too good to be true, it probably is. But I would suggest to people that when you hear something that sounds too good to be true, look into it. Do a little reading, do a little research. Nowadays, it's so easy to do a Google search on a company or an investment and see what comes up. Sometimes you'll come up with scams. Didn't cost you anything to take a look at it, but sometimes you might be missing out on some really good things because of that old adage.
Well, you hear it here live, folks. Howard says to go ahead and Google and do all the research that you can because it's free. Let's jump over to Kate. Why is it important to add trust deeds to your overall investment strategy?
We preach it every day, diversification, right? You always want to make sure that your portfolio is not all in the market. So you want to make sure that real estate investments, whether they're here or with others, even here, diversification with different asset classes, borrowers, even in different states is very important. I know Howard and I talk about that with all of our clients on a daily basis about diversifying, making sure that they're diversifying their portfolios.
Straight into the point. I like it. Next up, Howard, let's try this one. Different investment companies. What I mean by that is, let's say people decide not to invest with Ignite Funding. What's something they should look out for when they are deciding to choose a different investment company?
Well, in our business, which is secured promissory notes, we are a mortgage loan originator and we offer fractional note investments to investors. A lot of people don't know how these investments work. And again, that goes back to the importance of doing a little research and getting up to speed on the mechanics of it. But in our industry, what you'll find are a lot of mortgage brokers who originate notes, and then they will sell them off to a third-party servicer and basically brush their hands clean of it. They earn a upfront commission on origination, and then they move on to something else. Mm-hmm. That's not necessarily a problem until there is a default situation. And then at that point, the third-party servicer is not in the business of handling the default, and the original mortgage broker who originated the loan is no longer in the picture. So then the investors are left holding the bag and have to figure out how to resolve the default situation and perhaps even foreclose and sell the property. And that can be an expensive endeavor.
Speaking of defaults, right before this episode last month, in the month of February, we did a 4-part series all about defaults, how we handle them, the notice of default, the foreclosure process, all that stuff. So today's episode, we're actually not going to talk anything about defaults. If you want to learn more about that, please go check out that 4-part series here on Deeds in the Desert. Mm-hmm. Next one's up for you, Kate.
Okay.
Why do borrowers pay such high interest rates to us at Ignite Funding?
Well, if it's a borrower that's worked with us previously, they've had a good experience here. We are able to loan a lot faster than larger financial institutions. So if it's a borrower we've worked with, a lot of times we can get that capital raised for them within 7 to 14 days, get their loan funded and get them on the way to starting their project. Larger financial institutions are taking 3 to 6 months in a lot of cases to get loans done for them. So, if they have to pay a little bit more for the term of the loan, they're fine with that. And the terms of the loans are a lot shorter. So our loan terms are anywhere from 9 to 27 months max, and they're looking for those funds only for that period of time. So once they pay us off, maybe they're going to look at other financing, that larger financial institution that takes longer. And then maybe it's at the lower interest rate at that point. They'll refinance us out, which is perfect for our investors because then they get paid off and they can pick their next investment and move on to a new property.
Kate said something pretty interesting. Howard, could you elaborate a little bit on it? She said that our investments are 9 to 27 months, but I thought a lot of our investments were shorter than that. Can you elaborate a little bit?
Well, yeah. So we structure our secured promissory notes for a large part because of regulatory reasons in increments of 9 months. So we'll have some loans that are 9 months. We'll have some loans that are 9 and 9, where the borrower gets one option to extend, and we'll have even other loans on rare occasions that are for 9, 9, and 9, where the borrower has two options to extend. So from the investor's perspective, you always want to look at that as it's either a 9, 18, or a 27-month loan in duration, because that's what the contract is written for. And the borrower, we have a contractual obligation with that borrower to allow them to use the money for that length of time. Now, in reality, most of the loans that we do are 9 months with one optional 9-month extension period, or 18. And last year in 2022, the average duration of all the notes that we received a payoff for actually came in on average at about 13 and a half months. So some of them go full duration, some of them don't. It's just the nature of the beast that they pay off in different time periods.
Let's jump into loan documents. So this one's for you, Kate. Why are there so many documents? Why is there so many things I have to do before the loan, during the loan, after the loan? What is all this stuff for?
One of the things that we pride ourselves on, obviously, is transparency. We're very transparent with all of the information that we are providing to our investors. But it's also for your protection. So when you originate a loan document, right, and you're placing on an investment, that is a 30-page document that you will be e-signing. Now, all of that, it has all the loan terms in it that you are signing into, that you are acknowledging that you're a suitable investor, that you're receiving that 10% interest, the terms of the loan, all of the legal stuff that goes along with it. And then we over-communicate, right? When we receive the promissory note and the deed of trust and the title policy back, you're going to receive more information from us, another email with more information, all for you to keep for your records, right? Because it's so important that you have that information for your own resources, as well as we are regulated by the Mortgage Licensing Division of the state of Nevada. The majority of the information that you are signing off on in that first 30-page document, a lot of it is mandatory that we provide that to you by that licensing division of the state of Nevada. So, and then throughout the process, we have to communicate the information to you. We do it several times. We will ask you to sign off that you received that information until the end of the term of the loan.
Well, basically all I heard was compliance, compliance, compliance. So. All right, Howard, this next one's for you. Why can't Ignite Funding hold my money? This is a question we hear all the time. A loan pays off. We have their funds here, and we have to send them back to them. Why can't you just hold my money for me?
It would be incredibly convenient and great if we could. Ignite Funding is not a licensed custodian. We're not regulated in the state of Nevada to be a custodian. And as such, we are only allowed to hold investors' funds in escrow for very short periods of time, usually prior or immediately after prior to loan funding or immediately after a loan payoff. As it works with the interest payments and the principal payoffs, we're mandated by state regulations to send that money back to the investors or to the investor's custodian in the case of an IRA immediately.
Makes sense. Makes sense. Sticking with money and payments, Kate, what does it mean by interest is paid in arrears?
So in arrears means that borrower is paying their interest for the previous month. So for example, we have just started the month of March. Our borrowers are sending us their payments right now for the month of February. Yep. So the interest that was charged. The reason that we do that is, let's say a borrower pays off a note in the middle of the month, right? Our investors are not going to receive a full month's worth of interest at that point. They will receive everything that they've earned up until that date, as well as the previous month, if it has not been paid out prior to that.
I'm going to stick with you on this one, Kate. What fees do I have to pay if I'm an investor?
Actually, here at Ignite Funding, we do not charge you any fees to have an account with us. You can have a individual or joint cash account. You can open a business account or a trust account. There are no fees for that. All of the money that Ignite Funding does receive is all paid by the borrower. As we are originating the loans here in-house with our underwriting department, if there are origination fees or points, those are paid directly to us by the borrower.
Okay.
And then from an interest perspective, if you are earning the investor 10%, for example, you can guarantee that borrower is paying 12, and that additional 2% is what we keep to service those loans on a monthly basis.
So that's basically how Ignite Funding makes its money.
That is correct.
Similar to like a bank.
Yeah, that is correct. So we do not have to pass any fees on to our investors.
Actually, if I may jump in, it's similar to every mortgage broker out there. This is the way it works in the loan origination industry. You collect a percentage fee up front for originating the loan, and you collect a percentage fee on every interest payment for servicing the loan. And so Ignite Funding is no different than any other mortgage broker in the industry in the way we get paid.
Since we're talking about the funding side, Howard, what big problems do we solve for our borrowers and developers?
Well, we give them access to capital. I think that's probably the most important thing. So real estate development is a very capital intensive endeavor. Builders and developers have to spend a lot of money up front acquiring the property, entitling the property, developing the land into finished lots, and even constructing buildings on those lots. That's a lot of upfront investment before they sell the finished product and actually get paid. So because it's so capital intensive, these borrowers, they need access to capital to acquire and develop the real estate. And they're willing to pay a higher rate of interest because it's for a short period of time, and they're anticipating earning a margin on the finished product on the back end.
Nice. Makes a lot of sense why a lot of borrowers decide to go with a hard money lender like Ignite Funding.
We're much easier to work with. We can originate the loans in a couple of weeks, whereas banks take months. And, when we say we show up to title with the check, we show up to title with the check.
Kate, is it easy to get their money out of the investment? Let's say they're 3 or 4 months into their first investment and something comes up and they need their money back. What happens?
Actually, no, it is not. These are not liquid investments. So once you sign into a loan, whether it's that 9, 18, or 27th month term, as we previously discussed, you are in that loan for the duration. So if these are funds that you're going to be buying a house a year from now, and you are looking at an 18-month loan, maybe that's not the right one for you, right? Maybe you need to look for something around the 9-month term. But yeah, these are not liquid. Once you're in for the duration.
You heard that here, folks. If you're trying to buy a house, send your daughter off to college, trying to go on that fancy trip to Europe, don't use those funds.
No.
Yeah, don't use your emergency funds for investing in these notes. No. This is long-term money.
Howard, are the investments regulated here at Ignite Funding?
They are. We're regulated as a mortgage loan originator by the state of Nevada, the Division of Mortgage Lending. So we do have to follow state of Nevada guidelines with regards to originating and servicing mortgages and loans.
Thanks again for listening to Deeds in the Desert. This ad is sponsored by Pillars of Finance. Pillars of Finance is an investment community created by industry experts for investors of all kinds. It is a virtual event that takes place on April 4th at 3 p.m. If you have not registered or if you would like to learn more, go to pillarsoffinance.com or click the registration link in the podcast description. And thanks again for listening to Deeds in the Desert.
All right, we got 2 questions left. These are more for opinion's sake, so I want to hear what you guys both have to say for this one. So Kate, first one's for you. What is unique about the company? What's unique about us here at Ignite Funding in your eyes?
Here at Ignite Funding, I would tell you that we are supplying to our investors an amazing product, right? A lot of people don't know that these type of investments are out there. For Howard and I both, it's all about education, right? And the number of people that we can talk to and get the word out and let them know, as we started with this, that these investments aren't too good to be true. Let us prove it to you, right? We do it every day. We have over 3,000 investors that we deal with worldwide that are experiencing this.
Yeah, and just to add to that, mortgage brokers are in the business of originating loans and collecting a commission. Mm-hmm. Ignite Funding, typically mortgage brokers are not really concerned with the borrowers or the lenders. They're concerned with originating the mortgage. Ignite Funding, we are very focused on our investors' capital. We are looking at everything from the investor's perspective, and I think that makes us unique in the industry. The investments that we produce they're very secure and very stable, and they don't fluctuate in value. They produce a very consistent double-digit return. And I'll tell you an interesting story. I was at an event just last weekend where I met another hard money lender like us. And he was, I was telling him that we, typically charge, our borrowers 10 points, note rate of interest plus 1 or 2 for origination and 1 or 2 for servicing. And he's like, wow, I charge 16 and 4 points for origination. Wow. But he also told me is that 32% of his portfolio is in default. So, there are higher interest rate opportunities out there that carry with it a lot of risk. We're not interested in those higher interest rate opportunities and putting our investors' capital at risk. What we're interested in is creating a safe, secure, stable investment that's consistent over the long run. And that makes us a lot different than other hard money lenders out there.
I'm going to jump in on this one. And I actually kind of want to answer it more from the marketing perspective of what makes us unique. And it's a term that I feel like I've coined over the last couple of years, which is, we do everything from A to Z. And what I mean by that is not only do we originate all the loans that we produce, we service those loans, we fund those loans in-house. We don't use institutional funds or anything like that. We also handle the foreclosure process, any taking back of the property. Everything's done in-house. We don't sell off your loan. We don't just service the loan, and we don't buy loans from other people and then service them, or we don't just originate and then sell off. I feel like that's a huge, huge competitive advantage for us here at Ignite Funding when we're talking to investors that, when you decide to invest with us, we're going to be with you till the end. When that loan either pays off or if something does go south, we're going to be the ones to handle it. You're not going to have to worry about calling some other third-party company. And
you left one piece out. We source all of our own borrowers too.
Yes, yeah.
So we don't sit at our desks waiting for the phone to ring for a borrower to say, hey, I need a loan.
Right.
We go out and we look for the right kind of borrowers, the kind of borrowers who do a good piece of business and are looking for capital to expand their scope of operation.
That's perfect ending to that right
well
there, right?
Said.
So last question I have for you guys before we end today's episode is, should I get a financial advisor? Who wants to answer that lovely one? Oh, it looks like Howard's going to answer that one.
Well, that's a tough question to answer because everybody is different, okay? And financial advisors serve a purpose in helping people get their personal lives organized, helping them get their debt paid off, helping them build wealth for the future, and then helping them get involved in some investing to grow their wealth for the future. So, financial advisors' role is very important in society and very important for a lot of people. But there comes a point where you've done all of the things that a financial advisor can help you with. And then beyond that is where, we all need to kind of take the next step and do a little personal education and, discover other things out there that maybe the financial advisors don't really cover.
All right. So the best way to answer that question is depends. Depends on your situation.
Depends on the individual.
Yep. Depends on the individual.
Yeah.
Nice.
Absolutely.
Well, we're going to go ahead and wrap up today's episode of Deeds in the Desert. Thank you again to my two guests, Howard Robbins and Kate Buda. Thank you to all of our listeners for listening. We love doing these episodes every single week. All the education we provide you guys is all free. We're not going to make you guys pay for any of that because that's really important for us. Whether you decide to invest with us at Ignite Funding or not, it's important for any investor to know all the things and be as transparent as possible when it comes to the investment process. Again, thank you guys for listening. We'll catch you guys on the next episode.
Thanks for joining us this week on Deeds in the Desert, where short-term investments meet long-term investors. We hope you enjoyed the content so much that you share it with all your friends. Who doesn't like learning about passive fixed income, right? Still hungry for more education? Visit our website at ignitefunding.com. Or if you're ready to take the leap and start investing, give us a call at 702-761-0000 and schedule a free investor consultation.